Welcome to the Dividend Talk podcast, episode 170. Is a recovery on the horizon, followed by more earnings? Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom, and I'm joined with my co-host, European DGI. If you want to learn more about us, please visit europeandgi.com, where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter, which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. Hey, European DJI. Earnings is still going strong. How are you faring on getting through all these reports?
It's right. I love this. It's not like I'm reading everything to the last letter, but quickly scanning through the reports to see how my crown jewels are doing is something really I always really enjoy, because it's so nice to see your companies that you put your blood, sweat, and tears in with your hard money, let's say hard-earned money, and then to see them generally doing well. There are not so many companies in my portfolio that are really doing poorly, at least not according to my thesis. So it's just really nice always these seasons to get this confirmation. That's also what it is, right? For me, the annual season is much more important, where you can really get a bit of a deeper look into this. But yeah, it's always nice, and I always like kind of the price differences then, right? Sometimes it leads to thinking like, oh, am I getting it wrong with this company or not? And the other times it's like, oh, champagne is popping, yeah.
Yeah.
But then usually 5 seconds later, I think like, shit, I should have bought more yesterday, yeah.
Yeah, and hey, do you know what? That's probably a good intro into like some of the news where we wanted to mention the market. It's took a little bit of a bounce this week. You can notice a lot more people are more enthusiastic. Portfolios are looking a little bit more green. What do you think? Are we seeing the signs of recovery now? I mean, it is earnings, so a lot of companies are reporting earnings. The Fed have softened. I don't know if softened is too big of a word, but they've mentioned they're not going to raise hikes again, and the market seems to react quite positively to that. How did it make you feel? First of all, did you get all excited or?
So yes and no. Like, my rational mind didn't get excited because I just got my salary here, so I still wanted to buy more. My emotional mind, of course, got happy because it is nice after 2 weeks of just bloodbaths to see finally some recovery. Like okay, it's not that bad, yeah. But it also reminds me, like in March, where we had something similar after the collapse of this bank. We had it last year in November, December with the tech stocks all. So it is a nice time to be in, because we have it now like 2-3 times a year that we get these corrections, which are really like 10-15%. And it's good for us to be in there. In the end, we continue doing dollar cost averaging, of course. So I would say in the grand scheme of things, it doesn't really matter. But look, hey, this market is, from my understanding, is driven by interest rates. And usually we say like, let's not talk about this stuff on our show, because it's something we can't influence. It's something we can't speculate on. But I think this is what it is, right? In the end, is inflation in control? What about the interest rates? And I felt there was so much talk about it with the 10-year yield and everything. But then you hear suddenly some investors talking about like, oh, this might be actually like Bill Ackman. Okay, I think it's time to wrap up my short position on the 10-year treasury and such. Then you hear this Mark Hughes, I believe, saying like, okay, this is a great time to invest in bonds. So when you hear the professionals saying it, and then the Fed, it felt like, okay, I'm there might be something that we're nearing a point that I said maybe there was a bit of overreaction in the market. The question is, of course, is this 2-3 day bounce just a dead cat bounce? Yeah, and will we next week see everything in red again? We of course don't know, but what I feel and what I sense is that if yields like bonds are at 5%, let's say, that's high when you compare it to the last 20 years. Yeah, and it's a big shock to the system. So I can imagine that the Fed would like to see this lower in general, provided that the job market is not so tight. And that's the issue that we see, right? I mean, I don't see massive job loss around me. I do see layoffs in our industry, but I don't see people having a problem finding a new job again after that. So maybe really this interest is our rates are there for longer. But then the question is like, what you often see is like when there's so much noise around it that, okay, it's 5% really the 10-year treasury yield that we should see? Because I read some articles that if you take the emotion out, logically it should be more around 3.5% as an example.
Yeah, it's quite a funny market, as you said, driven by interest rates. And hey, look, I agree with you on the job front. There's like lots of talks of recessions, and I remember previous recessions where it really hit hard, where people were losing jobs and they were struggling because they couldn't get a job. Now what I'm seeing is the price of everything is going up. So when I'm working, people have to make cutbacks, but not so much that their overall lifestyle is hugely impacted. They still seem to be able to buy all the discretionary stuff. So it's quite interesting. I honestly did not care less that my portfolio was going down. Actually, when I got paid, my hardest decision is what to buy.
Yes.
There was just so much, and then part of you are looking at companies with 7, 8, 9% yields, and you're going, oh, I want to buy these, and then we had news about realty income, and they dropped massively as well. And there was just so many things I wanted to buy, and I just had so limited cash. It was a hard decision. So I'm glad I did buy just before the bounce. if it is a continuation, if it continues, but like honestly, I hope it drops again. I really do. T Rowe price was under $90 for a period. I mean, I really wanted to buy some of them. It was, I mean, look, I'm whinging because I want to buy more. That's kind of.
But T Rowe price on the 100 is still a good price, right? In my opinion.
Of course, yeah. It is.
But under 90 is even better.
Under 90 is even better, yeah. But hey, look,
so if a recovery is on the horizon, it's hard to say, right? This could be that cat bounce. We have seen this all too often. A 3-day joy in the market doesn't make it a full bull market, so to say. I think the issue just in general for the stock market is that bonds are literally an alternative right now. Yeah. So for many investors, this is not interesting, and specifically people that are usually having money also on the saving account that were pushed into investing it in stocks. So there was a lot of liquidity. Now people can decide to keep it on the saving account or invest it in bonds. So that usually means there's generally less liquidity in the market, which puts usually a pressure on the stock market with lower multiples as a result. Last year also we saw this for several weeks, and then it went up again. If you look overall at the stock market and you zoom out on the entire year, I think we spoke about last episode as well, it still looks pretty good. So I like you, I prefer longer sustained downturns, but it is nice to have a 2 or 3 days like this to just know that it's not just all doom and gloom. Just for the emotional side. I'm still human.
Yeah, we got a comment to that effect on Facebook, if I recall today, where people are just overall like we always say, try not look at the share prices, and honestly, over the last 2 or 3 weeks, I barely looked at my portfolio. I did not really care that it was in the red, honestly. But like, it's just crazy how much it influences people. And as much as you say, don't look at them, I think it's in your face so much, it's hard not to. So I can understand it. I can understand why people feel like that. I didn't feel the same because I didn't check. I really did not go into it. Like I really didn't matter to me. It just mattered when I was buying some what to buy. But yeah, I get it. When you're looking at the money that you've worked hard for going in and it's going down in price, it's hard to stay motivated. So
I mean, we're such an awkward species, right? If you tell to your family, and I have it sometimes as well, right? When speaking with others, and then they say like, "Oh, the mark was down," and then you know, when I hear this, a big smile turns on my face. They almost sometimes feel like you're trying to piss them off or something
you're
like that.
crazy. You're crazy.
Yeah,
And
you're crazy. Like, what are you saying? You're losing money. I said, well, I got to buy much more business for the same money. You know, how cool is this? And they look at you and they think like, what a wacko. Yeah, and that's really in a nutshell the life of a dividend growth investor. And when you think about your circle of friends, like we're just a bunch of idiots in their opinion.
exactly, yeah. And to be fair, if you're on the outside looking in and somebody's smiling because they're losing money, you'll be thinking, I'm staying away from this guy.
Well, dividend growth investors would throw a party if the market is down 10%.
But let's see. It's still too early. It's still too early to say it's a recovery. But look, who knows?
Yeah.
We might have seen the bottom. We might not. But
No,
let's
exactly.
focus. Let's focus on dividends, boys and girls. Let's focus on
Yeah.
dividends.
So, and this is really great, right? We're talking here about the stock market correction in the last few weeks. But then, you know, if you think about dividend hikes, have you heard what Snap-on did today?
Yeah, 14%.
14%. I mean, and how many of those double-digit hikes have we heard about the last few weeks? It's amazing.
Just even look at the last week. I can think I have 4 wrote down in front of me. I have four companies with double-digit hikes, which is crazy. EOG Resources, a company I mentioned a long time ago, 10% hike, but also on top of that, another €1.50 or $1.50 special dividend. That's on top
Hallelujah.
of $1 special dividend that they paid throughout the year, and last year they paid something like $3 or $4 as well. It's just phenomenal stuff.
Yeah.
AFLAC, ticker symbol AFL. We all know
The one with
Tiago.
the duck.
Yeah, we know Tiago, a guest on our show a number of times. Wrote, I think, maybe 2-3 in-depth articles about these guys. He was very bullish about them, and they've announced a 19% increase in Q1 of next year. And then we can't forget about our Canadian friends, Canadian Natural Resources. They've had an 11% hike. But that's 4 companies, as you said, when we're in the middle of a market downturn with double-digit hikes.
I would love to hear from our listeners who will be getting a double-digit salary hike this year, or let's say in 2024.
Yeah.
I would really love to hear it. I bet you it will be like maximum a handful. So but then you see these dividend hikes, it's so clear. It's better to be invested in the company than being a shareholder. It is so clear.
Yeah, and it's funny, sometimes you see, right, you might get a salary increase of double digits, but usually that's followed with some sort of title, maybe got a promotion, and that probably means more work. Whereas here it means no work, or the same amount of work, and you get double digits. So it's win-win, isn't it?
Exactly. But hey, there was even some more news this week, right? Realty income. What about that one then?
Yeah, I mean they acquired Spirit Realty. I believe they are acquiring that. I know you did a video on that, about your thoughts on that, and just for our members of our newsletter, and it's quite good. But it was kind of a neutral decision. I know it's given them more diversification. They're saying it's adding to some positions that they already have. I've noticed Walgreens is getting a lot bigger, and considering the trouble they're in, I'm not too pleased about that either. But it was an interesting one. I think if you're a Spirit holder, you are probably happier. I know their share price jumped up quite a bit, and Realty Incomes did the opposite since that day. But honestly, I bought more on that day. I was saying I was struggling with the choice, but that was fresh in my mind with the news the day I was buying, so I had to buy more shares.
Nice one, nice one. Yeah, I think, I mean, my opinion really simple. Realty Income has been making use of the downturn. They were able to buy a company for 9.3 billion, and I know people look at the share price and think like, oh, that's a 30% premium, but you need to know that companies typically pay for the enterprise value. That is the equity plus the debt in the company. Yeah, so and the equity is what is referred to as the market cap, the share price, but then you always need to add the debt, and then you get the enterprise value. And what they do now is they buy this, and they buy this debt at an attractive rate, so they don't need to refinance the debt from Spirit Capital. They keep it at 3.5 or 3.6%. While I said if they would issue it with debt, it would be 5-6%. But what they have been doing now is issuing shares. Now, of course, they pay dividends on these shares, so there is also a cost of capital there. But in general, you can see it a little bit as a spread play that they have been doing with this at relatively attractive terms. And then that's what's nice, what the company has been doing here, I would say. So I think if you're a management of Realty Income and you believe in the future of your company, then while I don't like share dilution so much, but we know that this is one of the vehicles that REITs can get an attractive funding, let's say, to acquire. So if now the share prices go up on Realty Income, that means also the underlying assets that they bought, and then they've been just creating shareholder wealth in the long term.
Yeah.
And I think it's accretive to 2.5% AFFO, so that's almost nothing, in my opinion.
Yeah, exactly. Basically nothing. So, look, I don't know if it came out of the blue, but it's an interesting one. But I mean, Realty Income under $50 is we know they're suffering with interest rates. We know they're going to continue to suffer until we start to see them softening. But to me, it just smells of opportunity.
Yeah, the balance sheet. Hey, but our friend Brett Thomas on the podcast was right? He was expecting lots of consolidation. He was expecting asset sales by the big companies where they would spin off their own real estate, so that real estate investment trust could acquire it. And so far, he's been onto something.
He's been spot on. Yeah, they call him the REIT guy for something.
Yeah, exactly. And I know he's not the most popular everywhere because he also, had some bets that went totally wrong. But generally, he might be right with his hypothesis that he was sharing on the show here.
Interesting. I actually have to go back and listen to that and make down some notes myself.
Effectively, he was saying he expects early next year the interest rates to cool down and the market to recover. So now's the time to accumulate these real estate investment trusts here. And I've been doing that. If I look at my portfolio, like early this year, it was a lot of insurance when the insurance stocks were down. Now it has been more of a bit real estate investment trust. And often there are these sectors that are just in having some headwinds, right? Sometimes it's consumer staples. Last December, it was information technology.
Yeah.
And I usually use this opportunity to be then a little bit buying more of those during that time. Good. Hey, let's go to some earnings. And we have taken some non-typical earnings, I would say, in this case.
Yeah.
But we do speak often about the first one. So can you talk a little bit about our German powerhouse, BASF? And I'm very curious about this one.
Yeah, German powerhouse. We know they're in the global chemical production business. And I think we spoke on last quarter as well. And they're in a bit of a tough moment at the moment. Production is down almost everywhere. So they're really struggling. You can see EU has been hit hard. Mainland China is kind of keeping them a little bit afloat, but they are struggling. Sales was 15.7 billion compared to 21 billion in the prior year quarter. So that's a huge difference from them, and that's from lower prices, but also lower volume as well. So they've been hit really hard. Earnings before interest and tax is also down for the same reasons. The only positive thing you can kind of say about them is that their cash flow has increased. So the free cash flow has increased this year. That's primarily due to reduced inventory. So they're not keeping as much stock because there's not much demand for that. They are spending a lot of capex at the moment. I think we mentioned for that site in China, so that is progressing. I don't think that will be complete until 2025. So there's going to be a lot of capex going out until that's built, and then we'll start to see capex reduce, and then maybe some revenues and some earnings go up. But I mean, they could be in for a tough 2 years there. Reading what the CEO is saying, he is pretty much saying that they expect this year and next year to be tough. What I did find really interesting was their talks about not so much about the dividend. Well, he didn't mention too much about the dividend, other than that it will depend on the economic environment and how that continues to play out. They're talking about stabilizing, and is it stabilizing? It doesn't look like it's there yet. So we might see some further reductions from them. So I would keep an eye on the balance sheet. It is okay at the moment, but I imagine that will deteriorate over the next year or two if we continue with the same levels of production. They've stopped share buybacks, and we know they cut the dividend back in 2010, so that's not ruled out either. I think they're trading, actually, their share price is around the same price as it was back in 2009, 2010. So I would envisage, if we start to see them struggling over the next year, we could see 20-25% dividend cut from these. So I think it's definitely something to
what
watch.
you're saying is that the dividend is unsafe at the moment.
I think it could be unsafe. Just judging from the comments, he didn't directly say it, but he's just saying that, look, with the economic environment, we're in trouble. The dividend might have to match what's going on there. So, yeah, I think with chemical production the way it is, everything that's going on around the involvement in Russia and the whole lot, it's a tough moment for them at the moment. But
you own some BASF, right?
I do own some BASF, and it's a tough one. It's a tough one to take. I have them at a slightly higher price. They are quite cyclical as well. We know that.
Yeah.
So this is probably, if you didn't own them and you could factor in the cut and dividend, it's probably a good time to start buying them if you believe that they can come out of this. But
what is really interesting is that they're struggling in the cycle, while you see generally the energy sector and the industrials are not at the bottom of a cycle.
Yeah,
they're rather at the top of a cycle, and BASF is struggling already. So imagine that now there comes a global slowdown. This company will be slammed from all sides, and
yeah, I mean,
because it's already struggling now under relatively good circumstances.
Yeah, and this winter could tell a lot from Europe whether that production is needed. We might not need as much if we have a mild winter. So it's definitely one to keep an eye on, and definitely watch that balance sheet. It's okay now, but 18 months.
So are you considering selling at the opportunity, or because it's a high dividend yield? But if you say that the dividend is quite questionable or unsafe, then why wait? Yeah, because what is it, 40 euros now? If they cut the dividend, it might be 25 euros.
Yes,
yeah,
exactly.
So that's my learning typically. Like, if you see the signals already and you're in it not for the high yield, but for the dividend growth and the dividend safety, then the question is, of course, why wait? If you lost the trust in it.
Exactly, is why wait. And look, they talk about stabilizing, so I think we need to give it another quarter or two to see if it is actually stabilizing. But if we see further declines, it's probably a good time to move on, in my opinion.
But if you say quarter or two, that means after the winter. You want to
after the winter. Yeah.
Okay, cool. So I looked a little bit in a holding of mine that I own already for many years, but where I'm sometimes wondering, as with BASF, should I just sell it? Yeah. And this is Omega Healthcare Investors. And we spoke about it a few times on the podcast in the earnings, but you know what the issue is. The dividend has been flat for several years at 67 cents per quarter. They have been really struggling already a bit before COVID, but during COVID even worse. So what they effectively have is nursing facilities. I call like the last mile of someone's life here, like the last week. I think they probably have about the entrance like Stairway to Heaven. Yeah, you just know that if you get in there, you usually don't get out of it anymore in their facilities. And many of their facilities have the facilities, their tenants, they have had issues, and there are two main issues. One is, I believe, Medicare, like getting proper funding from the government. Second, there's a big scarcity in proper staff, proper employees, that actually are educated and can do the job. Yeah, so many of the tenants have been struggling. Some even went bankrupt. Somehow they've been really managing it well during those years. Yeah, but on the other end, the narrative is just not changing. So I'm looking at the earnings report, and it says like funds available for distribution is 68 cents, which is 1 cent above the dividend. And this kind of narrative that I hear already 3 years, it's really like borderline. They've been selling a little bit of assets. They made a gain on it as well, so that's nice. They got some additional cash. But they also issued shares again to pay off debt as well. Relatively, they have enough financing to buy some stuff and to refinance debt, so it doesn't look too bad from that point of view. But then they expect their funds for available for distribution to be impacting again because of some restructurings. Many tenants are still on a cash basis here, and what effectively means is their tenants continue to struggle. They expect headwinds in Q4 this year and 2024. They expect the FFO to be a bit less than it currently is. So it will probably mean that they end up not having their dividend covered in the next quarter. But then it comes again. Long term, we believe the skilled nursing industry is well positioned to benefit from a multi-decade demographic tailwind. So effectively what they are saying is like this gray wave will come. The silver, I don't know how it's called exactly, but effectively all these boomers are going to die in the next decade. And they expect a lot of people coming in and then, not leaving via the back door, let's say. But I hear this already for 3-4 years, and it should have happened now already, and it hasn't happened. I just think that there is something fundamentally wrong in my thesis. The dividend is juicy with around 8%. I have reinvested a lot of those dividends, so generally, if I look at my return on investment, it has really done me well, Omega Healthcare, because just the 8% over those 4 or 5 years each year, and I believe my dividend yield on cost is 10% or something like that, has given me this return already at a flat share price, and then reinvesting that. But you can get other stocks now at an 8% yield that have a better safety profile. So, or maybe even 6 or 7%. I don't mind handing in a little bit dividend to get a better safety profile with dividend growth. So I'm really considering decreasing my exposure to Omega Healthcare, because honestly, I hear this narrative now already for 2-3 years. I don't see it returning in the numbers. It's all the time the same. So it starts to sound like a broken record there.
Yeah, I was going to say I've been listening to you talk about this company now since day one on this show, and I think you've basically said the same thing every time. And I don't know how they continue to do it. I think at one point you expected them to cut the dividend. They haven't. They keep increasing it slowly, but yeah, I mean,
it's excellent management. Yeah, that's what we can say. If you're facing such headwinds and you're able to keep the dividend flat and covered during those times where you're effectively all the time restructuring your tenants because and selling their facilities because they are going bankrupt one by one, then this is just a Houdini act what this company is doing and management is doing. Yeah.
But I agree with you. There's probably better at this moment. There's probably better options there. So it's, given the narrative and given how it's progressed over the last 3 years, it might not be the worst idea to move. But you'll miss them. You'll miss these guys. You will.
I can tell you, the moment I sell them, suddenly all the headwinds will be gone, and people are dying by the bushes, and there's just like money floating and slashing against the wall. Then that's how it will happen. You know this.
Yeah, of course. But yeah, look, it's one definitely for you to keep an eye on, and be interesting, even if you do sell, to see if your thesis would have played out long term and if their actual thesis plays out, because in theory, if you were to sit back even 3, 4, 5 years ago, you probably agree with him. Looking at it, you would
Yeah.
expect that thesis to play out, but who knows?
Yeah, and they have this really well in their investor relation decks. Often they show like how many boomers there are expected, how many people are expected to retire, in what age category. Yeah, and then you can just see that there must come a large wave of people that need their last few weeks in service support, let's say.
Yeah, nice one. We might move on then to Fresenius. We haven't spoke about them on this show for quite a while. I know they've been in quite some distress. Their share price was hammered, and shareholders were not happy. And I suppose in response to that, these guys have been restructuring quite big, I would say. I haven't looked at them in quite a while, so I had to get re-familiar with myself with them. But what it looks like they're doing is what they are called deconsolidation of Fresenius Medical Care, which is basically spinning it off to its own legal entity on the German Stock Exchange, and they'll hold a 32% ownership stake in that. I think that was voted for last quarter, and 99% of investors voted in favor for that. So to be fair, I think they've kind of recognized that they've held a lot of deadwood, and they're trying now to change things up. The same with their Fresenius Vamed, VAMED. I think that was running quite poorly, so they're doing lots of stuff to try and restructure that. And particularly, they are withdrawing non-core services outside of Europe, but also then focusing on 3 main areas, which is health facilities, high-end services, and health tech engineers. So they're really trying to hone in and focus on areas. So they're still in the process of doing that. They're still in the process of deconsolidating medical care. So there's still a lot of things to navigate through and to watch with these guys. What it does mean from a reporting side of things, it does simplify it a little bit, because we do know Fresenius was quite difficult to navigate through and actually try and understand. For reporting purposes, they have got rid of Fresenius Medical Care. They're considering that as gone already, even though it's not. But what they're left with now is a couple of investment companies and then a couple of operational companies. Fresenius KIBI or KIBI, KIBI, which is the global healthcare part. And then you've got Fresenius Helios, which is their healthcare division that owns private hospitals. So that's pretty much what they're left with. In terms of the quarter, so they focused on them too. They actually performed quite okay. Revenue increased 6% in constant currency, taking currency out of it. We see a 7% increase in Fresenius KIBI and a 5% in Fresenius Helios. So you're starting to see a little bit of growth there from both of those. But I suppose the big news is around the restructuring of the portfolio, how that's doing, and then what that outlook will look like. So I think it's actually one to put back on the watch list just to see how that plays out, see how that does, because if they can turn this ship around, I mean, it's an iconic company in Europe. The share price was hammered. There might be some tailwinds. There might be an opportunity to get in with these guys. But there wasn't a whole lot more in the earnings other than talking about the restructuring and the revenue. It's more of a sales update. So it's one to look at when they release their end of year report as well.
Yeah, I think I wrote a little bit about them in one of the newsletters that we had for free, like because there was some news, I think, surrounded by it. I just don't remember anymore. It was like newsletter 3 or 4. But generally speaking, I am not excited about them at all. I'm staying away from it. I find their dividend borderline safe. I think they froze the dividend last time.
Yeah, they did.
It's just such a shame that such a company, such an iconic company, is now in this space. Yeah, it deserves much better. And I think it's industry headwinds, but also just poor management decisions over the last 5-6 years.
It's nothing but poor management. And look, we know how complicated this business is, and they just struggle to get a grips on it. So I'm not surprised investors voted to simplify it and offload parts of it as well. But look, a lot hinges on this. And depending if they could turn that around, it's what we call a typical turnaround play, isn't it?
Yeah, it's a turnaround play, and I want to reduce them as much as possible
Yeah,
in my
yeah.
in my
So
portfolio. So
the question is if you believe they can turn it around, and management haven't shown that they can. But it's interesting to see what they're doing. They didn't just sit on their laurels and sit on their hands. They're trying to do something.
yeah,
Investors seem pleased that they're doing that, but we don't know how it'll
no,
play out. But
good. So then the next one that I think we should talk a little bit about, in my case, is Ferrari, maybe.
yeah, race.
So, this is kind of like, I don't know how many petrol heads are listening here, but this is really a stock for petrol heads, right? But listen up, revenues of 1.5 billion. It's up by 23%, 23.5% compared to last quarter this year. Now, tell me, how many tech stocks did you see growing with 23.5%? And I'm not talking about like stocks that just IPO'd 2-3 years ago. I'm talking about a classic company.
Yeah.
Yeah, it's really, really amazing. Did you know that their order book is already covering the entire of 2025?
Wow.
Yeah. So, think about the brand power and the pricing power this company has. It's amazing. They also, I said, showed off a new car, right? The 499p Modificata. And if you look at it's really inspired by the racetracks, right? But imagine having such a car on the road. I mean, that if you drive such a car, everybody will be watching you. Yeah. And I think this is the power of Ferrari. I mean, if you are in the midlife and you have the money, you buy a Ferrari. Yeah, that's how I look at these kinds of things. So it's a high growth stock, so that's why it has a low yield as well. But for instance, their earnings per share went up by 48%. It just shows how much of a margin they have. They upwarded and revised their guidance. Yes, so they expect their EPS for the whole year to be more than 655 compared to 625 and 640 of their guidance, while they had 5.09 last year. So we are talking here about 30%, 40% more, let's say 30% more EPS in a single year in growth. So yeah, you get it at the yield for 0.6%, but also the PE ratio of 50. Yeah, but a 60 billion market cap, 60 billion for a car company. That's a lot, and it's only, what is it, producing around 14,000 cars a year.
it's absolutely crazy. Could you imagine? Because we know they're linked to Formula One. That's their part of their strategy. Could you imagine if they were actually winning a world championship, or they were close to winning a world championship? It'd be off the scale. I mean, they're not exactly lighting Formula One on fire, and they're still able to do these types of numbers. Even though they talk about Formula One all the time and all their reports on their website, it's plastered everywhere. And I think, as anyone that likes Formula One wants to see Ferrari back on top. Everyone wants to see that red car across the finish line, but it's
except me, because I'm supporting Verstappen with Red Bull, so I'm totally fine with this. But I would like Verstappen to go one time to Ferrari, I must say, because I always have this vision of what Schumacher did, like the really great heroes, they went to Ferrari, and if he would go to Ferrari and then would win the title, it would show his master. It would show that he's really the best we've ever seen.
The best of the best. Yeah. I don't think that will ever happen, but who knows? Money talks. Maybe.
Well, maybe he gets bored at a certain moment and starts to realize that he can step into Schumacher's footsteps.
Yeah. Interesting. It's as you said, an iconic European company, and to see those numbers is quite impressive.
Would you like to own it?
I would just like to own it, just maybe one or two shares just because
As
it's
a token
as a
stock.
token. Yeah, yeah.
Yeah. Nice. Yeah, maybe then the last company that we really have to talk about, we also got a question about it, is from Hobby Investor. He asked us if we would discuss, how is it, Apple, and what's our take on it, because generally he says people are bearish on this company. So, a Hobby Investor, let me share a little bit just about the facts, right? Quarterly revenue was 89.5 billion, which is 1% less than last year, while their diluted earnings per share were up by 13% to 1.46. Now, if I look into the data, it's really simple. And I rather zoom out because these were also the annual numbers, right? They have their fiscal year ending now. They sold 383 billion in the last 12 months compared to 394 billion last year. So their sales went down effectively on the products, because if you look at the services, it grew by around 10%. So it's really like the product side that went down. And if you then zoom into that, you can just simply see that I said iPhone sales are kind of flat from 205 billion to 200 billion. Services are up, like I said, from 78 billion to 85 billion. But then look at, for instance, the Mac. The Mac really went from 40 billion to 29 billion. They lost 25% in sales on the Mac, and that's even after price hikes. So the volumes must have been really shattered there at Apple.
Yeah.
I don't know what it is, but actually I was last week in the Apple store. I don't even like the Macs that they are having now. They have these Fruity Loop colors.
Yeah.
I mean, who wants this in their living room? Yeah. I don't know. I like the other Macs much more. I think they went a little bit off track here. Like almost like this Barbie kind of screens that I saw. So maybe that's it. I don't know. I'm really not an expert in this. But if you look at the iPads and the wearables, it was relatively flat. What is, by the way, interesting is that the wearables. So we're talking also by the iWatch and such. They make 40 billion on this stuff. Yeah. So iPad 30 billion, let's say Macs 30 billion, and then wearables, home and accessoires 40 billion.
Yeah.
That's a lot, yeah.
And they've if I recall it right, they've released this new carbon neutral wearable range as well, which is obviously in time for Christmas, and we know there's a lot of hype around carbon neutral and stuff. So I think they'll probably just increase that by 10-15%.
Yeah, exactly. But hey, look, guys, really simple. They made in the last 12 months 100 billion in free cash flow. Yeah, 100 billion. The market cap is 2.7 trillion. So you're talking here about a 27 PE, let's say a price to free cash flow here. From this 100 billion, they only invested 15 billion to send it to the shareholders in the form of dividends, but 77 billion in share buybacks. And then you could argue, like, okay, they've been buying back at all-time high, but they've been buying back for the last 5-6 years at all-time high. Yeah. So you could just say also that they always recognize that their shares were undervalued, and that they kept it on autopilot. 77 billion on 2.7 trillion, and just these numbers are too big to even understand, but it's still 2.8% buyback yield. Yeah, so, and this is a lot, 2.8% buyback. Yeah, we had Shell this week sharing their buyback numbers. On the last 12 months, they are buying back 8.6%.
Yeah.
But they are having a PE of 6 or 5, yeah, with record, well, maybe not record, but really high free cash flows. But this is just a company at a high multiple, still buying back 2.8% of the shares. And they do this with hardly adding any debt. Now, for me, that is very impressive. So, I'm not buying Apple at this price of $175 and a 28 PE. I bought them at the time at a 13 PE. I don't believe it will get back there. But what I've seen over time, that every once in a while, let's say every 2 years, the narrative comes of the iPhone is dead or this is dead. Those are usually good times from my experience to buy some Apple shares. And we always make fun about Jim Cramer on social media, but he has one quote that always stuck with me. Own it, don't trade it. And that's also really how I feel about Apple. Just own this stuff. If you believe that Apple will be still having its brand power in 10 years from now, I'm pretty confident you will get a decent return on it. You don't need to have it for the dividend at 0.5 because they're not growing the dividend so fast like Visa or something like that you really benefit from it in 10 years from now. But generally, if you want to own it, it's really high quality company.
Yeah, it's definitely not a dividend play at the moment. At some point, you would have to imagine that the growth will stop, and they will have so much cash flow they'll have to return it to us. But yeah, I think that brand power Apple is just so iconic. Everybody has some sort of Apple device in their home, and will probably continue. So yeah,
here it comes about conviction, right? So my yield on cost is 3.10% on Apple, while it's now at 0.6. So every time it hikes with 10% the dividend or something like that, my dividend just keeps on growing. But I can tell you, I bought this stuff pre-split at the time at 120 or 130 or something like that. Yeah, so my shares went 4 or 5 fold. Yeah, I've got a 493% unrealized gains. Yeah, so it is just like, but this is why I like the value vesting part. Many people say always these are growth stocks, but even these growth stocks that pay a growing dividend, they go to summers, springs, but also through some winters and autumns. So there, while of course now we are living really in a tech bubble, but who knows? Maybe the price will go 40% down because the iPhone debt narrative comes in.
Yeah.
Well, those are the times to not borrow conviction, but to have your conviction ready, right? And this every year there's a stock. Now you could argue, for instance, about PayPal. I know it's not a dividend player.
Yeah.
Is PayPal now undervalued or not? Yeah, it's a tough one because there's always Apple at the time as well. They lost their mojo, iPhone, Samsung, and this and that, and we saw it with Microsoft in the past as well. And now with PayPal, all the fintech space is really competitive, but it's not like the mobile space is not competitive. Yeah, so it's really a question like, what is the moat of the company and what are the switching costs of the company? I think with Apple, switching costs are really high, not because you can just buy another phone, but it's about reputation. Yeah, not wanting to look like a fool among your friends.
Yeah, pretty much keeping up with the Joneses.
Yeah.
Nice one. So with that, then we'll continue with some listeners' questions. Because that one was from Hobby Investor who asked us to look into Apple. But we'll start with Adrian, and he's asked, how does high return on invested capital influence your decision to invest?
Yeah, no, it definitely matters, Adrian. It's really simple. There's a strong correlation between return on invested capital and the dividend growth potential of a stock. What I've seen time over time, if a company has sustainable low return on invested capital, usually it means that they're just not making a lot of money on the money that they're investing. So if they're investing, let's say, $1 back into their company, you want to get $1.10, $1.15, $1.20 out of it. Needs to be higher than the cost of capital. So if your cost of capital for issuing debt, for instance, 5 or 6%, it needs to be higher because otherwise you're just going into debt. And you see this with some companies with sustained low ROIC. This is also usually a sign of that they are losing some market power, some pricing power. So yes, it does matter, but you need to look at it over time because sometimes, for instance, a company needs to do a write-off on something or that, and then suddenly their ROIC looks low. So you need to look at the patterns a bit over the last 5 years, I would say. But yeah, I definitely look into that. And if a company has sustainable low ROIC, I really need to scratch my head. Usually it's then only if it's a value play that I think, like, okay, this company is like so undervalued that I can benefit from multiple expansion. But usually I don't really want them in my portfolio as, how you say it, because I'm a dividend growth investor. Yeah.
Yeah. Nice one. Jean Christopher has asked us about a company called Sika, ticker symbol SIKA.ZU. I think he asked us about them a couple weeks ago. They are a global leader in construction materials. He says they have a nice track record of growth, currently yields 1.4%, but the average dividend growth over the last 10 years is 14%. Payout ratio of 50%. What is our thoughts on it? I have to admit, I didn't know a whole lot about this company. When it's in Switzerland and the yield is low, it's typically a no-go for me. Pretty much because of the tax. It's typically not worth my while. I'm looking at a sub 1% dividend yield on that. But I did take a look at the company. They are a construction leader in their field, mainly with construction chemicals. I think they own 11% of the overall market, which is 2 or 3% bigger than their next rival. What I did like is that they had, if you go onto their website, they have a clear strategy and a clear policy. So when they talk about their strategy, they have a couple of growth pillars that they call, and one of them is acquisitions. And they seem to integrate them quite well over the last few years. This year, they grew 25% their revenues based on 2 acquisitions they did over the last 2 years. So they seem to be quite well in that department. And they make no secret that acquisitions is the key to their growth. But also the chemical part is outpacing the construction industry as a whole nearly double. And they're riding that crest. So they have this really nice actually investor relations presentation with their strategy up until 2028, and it does outline where they've been the last 2 or 3 years and the path that they're going to take. So it's quite interesting. It seemed like a good company. I looked at their dividend payouts and their policy. They do have a clear policy, and they actually say that let's say a consistent dividend payout is the sign of reliability of the company. Consistency at Sika is linked to stability, and overall, the continuously rising dividend payout reflects this positive profit development. So they do have a clear policy that they want to increase that. So as long as they're profitable, they will continue to increase that. Like you said, they have a good track record. Looked like they did some sort of split back in 2017. But yeah, honestly, it does seem like a good company. Revenues were actually nearly doubling over the last 4 or 5 years. So it does seem like a stable, good company to own in this market. It's just, for me, it's too low of a starting yield, and it's based in Switzerland. So I would just give them a pass. But I can see the attraction to them.
But it might be interesting then for Swiss investors if they have
Yes.
some tax benefits or something like that, or if they have some form of retirement account.
Yeah. I mean, they do have some strong brands pretty much in that area. So it's from brand power alone. If I was based in Switzerland and had tax, I would. The yield is still quite low, but I would definitely consider them a lot more than what I would now.
Nice.
Pascal has asked us about our thoughts on Nvidia. Obviously not your typical dividend stock, but do you have any thoughts on them?
Yeah, it's an awesome company.
Yeah, it's hard to argue. I mean, it's the kind of company you wish you owned at the start of the year before they took that huge run up.
Yeah, they are probably the biggest reason why Intel is in such a deep trouble.
Yeah, 100%.
Together with AMD. So I hope that Intel finds its mojo back. I still own some Intel, right? So that is one of the turnaround plays in my portfolio. But Nvidia is on fire. And what is really interesting is, like, look, they had already, of course, the asset in their the product in their product lineup, let's say, which was all about gaming, right? We all know the GeForce cards. And and then suddenly the boom of big data comes, crypto comes, and suddenly those stuff really seem to do well. The technology seems to really fit, so they won the jackpot with this. And of course there's visionary leadership behind this, but who could have known that it would have been a COVID, the crypto boom, and all this stuff behind it? I mean, preparation is half the job. But they literally won the jackpot with how the industry evolved. And I can't imagine that people can predict this to that extent. But hey, kudos where kudos belong, and brilliant company to have to own. But as it doesn't pay a dividend, I would look at undervalued companies, and Nvidia is just too highly valued for me to even consider.
Yeah, I do like the quote that Pascal left us that the CEO said. I love this quote. He says, "I like to position myself close to the tree so I'm there to catch the apple once it falls." Absolutely love that. Brilliant.
Yes, but there's so many trees out there. Which tree do you choose?
Hey, he seemed to know which one. He was standing right under it. To be fair to him.
Well, there's a forest outside if you look at opportunities, but he knows which tree. I mean, we say that we can't time the market, but I can tell you, I also can't find the tree in the forest here where the apple will fall. So it's a bit of bullshit, I would say as well.
Yeah. Let's move on. So Hans and Tavi. So Hans sends his greetings from Denmark and Tavi from Estonia. But both of them have a question around IIPR, innovative industrial properties. What's your thoughts on this?
Well, we know this company already for quite some time because this is the real estate investment trust. If you are betting on the legalization of marijuana, effectively, so that's what this is about. There was, of course, a lot of deregulation happening in America and Canada a few years ago. IIPR went into the stratosphere with that. A lot of speculation on this. Then it got out of favor. But hey, look at it. Let's look at the facts again. Last 12 months, funds from operation, $8.11. Dividend per share, $7.20. Dividend is covered. We know that real estate investment trusts have high payout ratios, 9% yield. So the only question here is, do you believe that the company can continue growing? That's a question that I cannot answer because I haven't looked into it deep enough. But if I look at the fundamentals today, company looks quite solid. I would say it's just a question like, do you want to also own a position in such a heavily regulated industry, or even though deregulation is happening, but with the risk of further regulation or the risk or the uncertainty of further deregulation, because then the question is where the growth will come from, right?
Yeah.
So I just don't prefer usually such a governmental invisible hand over the stocks in my portfolio. And of course I have some, but generally I like to keep that to a minimum. So yeah, interesting one. Doesn't fit in my portfolio, but when I look at what I would say to Hans and Tavi, like, ask yourself the question, like, do you truly think that it has enough room to grow? That would be the main question. And if you can answer that for yourself, then you probably know whether you need to build your position out here.
Yeah, you're basically betting on marijuana here, and as you said, governments are deregulating it, but they could just as easily put more regulations on that. But you're getting a high yield to take that risk. But yeah,
the risk probably, the yield probably reflects the risk that you have as an investor. It's like Omega Healthcare, 9% there. There are doubts surrounded to this. I think it's typical for a stock at such yield. We have it with NN Group as well, with the court ruling that we saw.
Yeah,
there's a reason why they trade at 9% yields.
Exactly. Kevin has asked us about Canadian DGI stocks. Kind of a two-part question. The first one is he likes one called Canadian Tire. Do we have any thoughts on them? And then the second one is, our Canadian stocks in general a little bit forgotten versus the US counterparts? I would say, if you're from Canada, no. But probably for investors in the US and maybe typically Europe, at least the ones that we chat to, I would say that the US is probably more favorable than Canada in terms of investments. It doesn't mean the companies are any better or worse. It's probably there's a lot more American news presented to us than there is Canadian news, so it's easier to stay up to date with what's happening in America. And that kind of goes for this company, Canadian Tire. I honestly never heard of them. I looked them up and they're talking about their consumer brands division. So I had a look at what brands they had, and they must have mentioned 14 different brands. And honestly, I did not know a single one. I didn't know. So
Yeah.
for me, it would be hard to connect to this type of company. They are a retailer. They do sell other brands that I know, but they're third party, but their own brands I know nothing of. And they're saying that's the driving force behind their growth strategy is their consumer brands. So I think if you're from Canada and you use these brands, you know what they are, you might know the growth drivers, it might be easy to understand this company. But for me looking in, it's hard for me to gauge that. I don't know how popular, how good these brands are. Are they useful? So I prefer to stick to companies that I know a little bit more about. From a fundamental point of view, yeah, you're dead right. They have a good history, low payout ratio, and they seem to be growing in terms of top line and bottom line. But as I said, it's hard for me to connect with a company like this, so I'd have no interest in pursuing it.
Nice, thank you.
And then we have a question from Richard Taylor, and he's asked us, do we have any thoughts on a company called Smith's News, ticker symbol SNWS?
So yeah, 8.6% yield, and as Richard says, it's the UK's largest newspaper and magazine distributor. 55% market share, 24,000 retailers where they have their stuff lying there in England and Wales. So what is really interesting here, Richard, is that I was surprised that, let's say, such a newspaper distribution companies are still kind of interesting, yeah, because you would think like, okay, who still buys this? But yeah, when you go to shop, you still see it, right? I'm usually only interested in the Sudoku guides because that's what I'm playing all the time to nurture my analytical mind. But Richard also says like they have a patchy recent dividend history, and he bought them like at £30 last November, but he still thinks there's some growth left into it. Now, look, Richard, the whole answer here for me is probably very predictable. Like, but you need to know why you own it, because when I hear your story, it sounds more like a value play than a dividend growth play. Because for the dividend growth, the dividend doesn't seem safe. If you look at the recent history, there's no dividend growth policy here, at least not in action. So what's left then is if it's a valuation play. And for a valuation play, I think it's even more important to understand the ins and the outs of the industry and be able to do a really good forecast on how this would evolve. And I'm really not the right person to give you any answer here. Look, what I can say is that it has a PE ratio of 4.7, which generally is very, very, very low. Also, if you look at the market cap, it's 120 million. So we're talking here about a small cap company. Liquidity might be sometimes an issue. So please be aware of that as well, because there's not so much trading going on. So, but honestly, because of that, I'm not interested in it. But I can imagine a PA ratio of 4.7 and just multiple expansion to 6 or 7 would already give you 50% upside potential. But that's a question you need to be able to ask to answer yourself. It's really hard for me to judge that. Specifically, I don't have any brand affinity with this.
Yeah, and it's as you said, it's a tough industry. I have a friend who lives in the UK actually, who owns his own publishing company, and this was 2 or 3 years ago, and they were starting to struggle. And we know lots of things are going online since. So it would be a market, or it would be an industry and a company I would struggle to see future growth in. Actually, something similar to tobacco stocks, where I would say arguably it could be a declining market in my uneducated opinion, I would say, on a company like this. But look, patchy dividend history, like you said yourself. So from a dividend growth perspective, it doesn't interest me. From a value perspective, it doesn't interest me. There's lots of stocks in the UK stock exchange at the moment that are yielding quite high. I know that market's under pressure, and there's definitely better companies, in my opinion, to chase.
But if I see such a company, right, and if the dividend history is anyway patchy, I would actually consider not. If I would be management and I cannot pay a growing dividend, I would just cancel dividend and go massively into buyback at a PE of 4.7.
Yeah,
I would just use all my cash flow after reinvesting in the business to buy back as many shares as I could.
pay down debt and buy back
Yeah.
shares. That's probably
Yeah. Yeah.
Okay, let's move on. Hugo has asked us, what is the max percentage of small/mid caps that you feel comfortable having on your portfolio? If an incredible opportunity arises on a small cap and you already have maxed that limit, would you cross that limit or sell a current small cap position?
I don't have a maximum in there. I just know that I naturally gravitate away from it here because of, for instance, the lack of diversity in the market, or just a niche market too small or something like that, or therefore not really having an understanding of the market. But I don't have a particular percentage with a threshold here. So what it means for me, if there are incredible opportunities, I will always consider them here, because it will never naturally be a big part of my portfolio. For instance, when you look at small caps, I've got Chesnara and, for instance, Defama. Those are classical examples for me of small caps, and I feel totally fine owning them.
Yeah, I don't have a max percentage either. I think, like most investors, particularly I would say dividend growth investors, you tend to focus on companies with longer histories and probably more mature, and they tend to be large cap. That's not to say there's not those types of companies in small to mid cap, but generally speaking, it is more large cap. I think there is plenty of opportunities in small cap and mid cap, but I think you need to maybe understand the company a little bit more in depth than you would with a large cap company. So I think you have to have a deeper understanding and feeling. But like that, I would have no qualms about investing if an incredible opportunity arises. I don't think I would sell a current position unless I wanted to sell it anyway. I would probably cross my limit if I felt it was too good to be true. I would probably cross my limit. Gordon has asked us about ETFs. If the likes of SCHD and VIG were easily and readily available for us, would we still invest in individual stocks?
I would definitely have a mixture of stocks and ETFs. I would like to own some SCHD. VIG, the yield is a little bit too low, and then I would just say, like, I can do cherry picking out of what they have in their index. But SCHD, I would definitely like to own that because I like their strategy and the index that they follow and how it's set up. I like that quite a lot.
Yeah.
So yeah, I would definitely, and I think it would be a large part of my portfolio, honestly.
I think if I was starting out fresh and we had those types of ETFs available to us, I would probably be a pure ETF investor. But knowing what I know now, and I didn't have that opportunity, I would definitely have a mixture. Because I do like the process of going through companies, having a thesis, and seeing if that thesis plays out. But yeah, definitely, I would think if those were available, I would definitely have at least 50% of my portfolio in it, and also my kids would have a large percentage of their portfolio.
I could imagine also like the numbers of 50%. I would always buy in individual stocks as well, because there are just some stocks that I really would like to have direct ownership in and such, but probably I would anchor probably at around 1 or 2 ETFs like that. SCHD probably is a good one because there the yield makes sense. For VIG, when you get 1.3% yield, it doesn't make a lot of sense for me. Then you can better cherry pick the dividend aristocrats out of it that are having a decent yield.
Steve has asked us, if you had your younger and very amateur investing self sat right in front of you, what advice would you give him knowing everything you know now?
Trust in yourself.
Go all in on Shell, baby.
No, just trust in yourself. I've been in the beginning doubting myself quite a bit. Like, am I a good investor? This and this, taking too much weight on failure and too little attention to success. I had to grow into that with investing. So because I've been reading every book I could. Yeah, I've been deploying all the money that I could, but I kept on doubting for a long time. And so trusting in yourself, also understanding that you will make mistakes, but it's more not the fact that you make mistakes, because that's a humble experience, but more like how you act after that. Yeah, will you continue making the same mistake? And I do continue making some similar mistakes, but they becoming less and less and less. So I feel like I'm growing and learning as an investor. And which is also really interesting, because SBT 92, if you're a young person, I did a poll on the last podcast, and I think 60 or 70% feels that they are not a good investor. Yeah, and I did the same poll on Twitter, and 75% out of 800 people feels that they are not a good investor. And this is a mixture of people that maybe already investing for 10 plus more years. So also that is good to know. Like, you will never do perfect. You will never do well, probably.
Yeah, I think you have to learn to accept mistakes. I think that's
Yes.
part of the
Yeah.
game. Everyone talks about Warren Buffett as one of the greatest investors of all time, but not everything he is invested in has
I
been.
made big mistake with IBM as an example.
Yeah, I mean, it happens, and I think that's something you have to definitely. If I was talking to myself, you have to just accept it, learn from it,
Yeah.
and move on. Don't dwell on it. If you lose a little bit of money, you lose a little bit of money, but it's what you do after that, I suppose, is what.
Yeah. If you're like, out of the 10 stocks, if you're 5 times having winners, they will bypass very easily the 5 losers, because if the 5 losers go to 0, but the other 5 more than double, or let's say double, you're already winning. Yeah. So it is really this diversity that's also key there.
Yeah, and I would also tell myself not to compare myself against others, particularly because whatever journey they're on, they're at a different phase than I am, and it's easy to
And
get
I remember you bought a lot of stocks in the beginning because others had them, and I had that also in the beginning. I was buying Kimberly-Clark because Jason Fieber owned it, and he really convinced me. But like Tollgate this, but I never really grasped the company. So I would never buy a company that I don't fully grasp, just because someone else made it popular.
Exactly. There's been plenty of times since where Twitter has made companies seem like they're a must buy. But
hey, you can't borrow conviction. That's really one of the items you're still talking about all the time on the show.
Okay, and final question of the day from Rico, and he's asked us: do you intend to make any wash sales this year to reduce your taxes? So basically selling a company at a loss.
Yeah, I will. Probably Alibaba that I have in my portfolio. Probably Alibaba.
Yeah, nice. I don't know. I have to check and see what my tax situation is like. I'll probably do that at the end of this month and see, but I think I'm okay. I sold AT&T this year and I made a loss on those, so I might be okay.
Yeah. Good, that is it. Thanks so much, Derek. We're at the end of the show again. Always a pleasure talking to you, and we got some really nice questions again. So yeah, hey, if you're still hanging on here, guys, time to wake up, time to get to work, time to do whatever you do. If you still need to run a kilometer, I wish you luck, because now you need to do it on your own. But have a good day, guys, and see you on the inside next week again.
See you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.